What is up, guys? My name is Isaac Suter. I'm here with Quarter Life Crisis. Do you want to make millions of dollars in just a matter of days? There's one technique that can let you do just that. Do you want to hold on to something worth tens of thousands of dollars today that could honestly just be worth pennies tomorrow? Again, we'll be talking about that in just a minute. In fact, what I have to tell you about today, one item fits both of those criteria. While this is a slight exaggeration, cryptocurrencies such as Bitcoin do have such a volatility of price that they can raise and lower by hundreds or thousands of percent in just a matter of days. Introduced at an exchange at 1,309.03 bitcoins per US dollar in 2008, the price of Bitcoin has risen to $7,133 as of posting this video right now. At its all-time high in early January, it rose to almost $20,000. Here is a graph that we have which shows just the enormous raise, and you can see here in early January just crashed by over half its value, and it's continued to plummet in the last couple of weeks down to about 7,000. Cryptocurrencies began in 2008 with Bitcoin, which was created by an anonymous figure who goes by the name Satoshi Nakamoto. So what is cryptocurrency? What is Bitcoin? And who is this Satoshi Nakamoto? No one knows who Satoshi Nakamoto is. He may even be a group of programmers who work together. It's likely he's either one or several members of a small group of cryptographers who were working together in the early 90s. So let's start with what cryptocurrency is. First, there are thousands of cryptocurrencies. Bitcoin is just the first and the most popular. Cryptocurrencies, or digital currencies, were created in order to have a decentralized, portable, and easy to access and easy to exchange currency for the whole world. They were developed as a byproduct, basically, of attempting to create a peer-to-peer digital cash system. So we're going to start with what's called the blockchain, which is the technology that cryptocurrencies work on. Blockchain is a tamper-evident shared digital ledger, which means that it records all transactions on a peer-to-peer network and permanently records these transactions in a linked chain that link together using blocks. It relies on many computers having a shared consensus that a transaction occurred, how much it was, and what wallets or users it was between. This prevents fraud and tampering. So what else do we have? Mining is a huge thing with cryptocurrencies. As with any currency, there's a need for cash to be entered into circulation. In the United States, the Federal Reserve is in charge of adding money into the circulation, but because cryptocurrencies are called deregulated, which means that money cannot be added to banks when they need cash in the same way the U.S. government does it. Instead, cryptocurrency uses a process called mining to add money into circulation and verify transactions. Basically, when you swipe your credit card at Subway, massive servers owned by your credit card company and Subway's card company and big banks and stuff interact to verify the transaction and ensure that your money ends up in the right hands. The point of decentralization is that some people believe that this power shouldn't be held in the hands of conglomerates or corporations. The people shouldn't be afraid that their ability to transfer money will be manipulated or abused by these massive corporations. Cryptocurrency, however, uses hundreds of thousands or even millions of consumer and user computers to maintain their networks and verify purchases. This process is called mining and results in financial rewards being given to those who help maintain the network. This works to incentivize users to allow the currency to use their computers, as well as keep inflation steady and introduce new coins into the market. There are two types of mining which I'll go over. The first is proof of work. Bitcoin is what we call proof of work. Proof of work is probably something you've heard of. In proof of work, a graphics card from your computer is used to perform difficult hash functions to verify transactions. Computers across the world mine and process transactions, providing consensus and adding them to the blockchain when they are proved. Because so many computers are needed to agree, the integrity of the coin is assured, and people have faith that the transaction will take place and there's no fraud. This is an example of a miner. This particular miner or program, which your computer can run to access the network and be provided with hashes necessary to complete, it mines through pools. This means that many mining computers work together to complete the mathematical hashes required to verify. Because rewards are only given when hashes are completed on time, this means that smaller computers owned by hobby miners, people who do it just for fun, can still earn money and complete hashes regularly, even if they only get a percentage of the reward because it is shared across all the members of the pool according to their processing power. I have a monster computer that I built myself. It has a dedicated graphics card, an i7 CPU, and 32 GB of RAM. But even with all this, as you can see, I'm making mere cents per day. Prior to the Bitcoin crash in the beginning of the year, where it dropped from almost 20,000 down to 7,000, I made almost $3 a day. But even still, this is not exactly something that scales. So what options are there if you want to make more money? This is where we get into the second type of mining. This is called proof-of-stake mining. Recently, there's been a huge surge of cryptocurrencies that are proof-of-stake. It is an energy-efficient mining process which does not require a specialized computer. It can be run on a 10-year-old laptop as long as the program can be run on the operating system. So this means everyone, even you, yes, you, could be making money right now on whatever computer you have for hashing out Word documents for class or work or whatever. So how does this work, and what is the downside? Proof of stake does require users to own a selection of coins. They then leave the coins in what's called a wallet. Basically, it's like an open bank account. I have an example right here. This is my OK Cash wallet that holds my balance and stuff like that. So first, as long as this program is running, the coins begin to stake and earn you money. You are attributed hashing power equivalent to the number of coins you own, and thus the more you hold, the greater your ability to earn money. This also means in order to earn money, you have to first buy a decent number of coins first. This startup cost can be just as much, if not more, than buying a mining computer. However, it also has the potential to earn money compounded. What this means is whenever you earn coins, those coins start earning for you. So the longer you run it and leave your coins there, that money is compounding over and over and over again. The other benefit of proof of stake is that your coins can increase in value as they sit in your wallet, much like stocks. So your holdings increase US dollar amounts at the same time you're increasing in the digital currency, earning you money on both sides. So you can see here I have some coin staking, earning, this is just a small amount, it's only a couple of dollars worth, and this coin earns 5% more coins each year. That isn't much, but it's kind of like a dividend on a stock and earns more than basically any savings account that I know of. So at some point I'll probably add more to that. I just wanted to show you guys what that might look like. There is one other way of making money using cryptocurrencies. This is also something that's required if you do want to acquire OK Cash or another cryptocurrency to do proof of stake. That is buying, selling, and trading. Let's say you want to get into cryptocurrency and you want to buy something. The first thing you have to do is to buy any cryptocurrency, you have to start with one of the main coins. These coins include Bitcoin, Bitcoin Cash, Ethereum, and Litecoin. First you go to Coinbase, which I have my account open here. You create a login, and then you can enter your bank account details and trade US dollars for one of these four main cryptocurrencies. Then what you're going to do is you will then transfer your cryptocurrency using a blockchain. It will be a transaction on the blockchain. You'll get a small fee, and you'll transfer it to a big exchange like Bittrex. Bittrex is basically, Bittrex and Binance are two main exchanges You'll log in. I've logged in here. I show you all the things that I hold stock in. And basically, you can transfer this any digital currency into whatever other digital currency you want to. You have choice of thousands and thousands of different currencies to choose from. Masses of them, really. And the idea is the same as stocks, where you want to buy low and sell high. Because of the volatility of cryptocurrencies, the potential of profit is very high, but there's also a high potential to lose big. So be careful if you decide this is something you want to do. That's all the time I have for now. One disclaimer: never invest more than you can afford to lose, and any information given by me should not be seen as a recommendation to invest. Please examine your finances and do research to determine if crypto investing or mining is right for you. That's it, and I'll see you all next time.